Well, good afternoon. I'm John Sangenberger, and I head the Alumni Relations team at the Tepper School of Business, and we're so glad to have all of you with us today. Thank you for joining us for our Alumni Investment Outlook 2021 panel. It's a very timely one, as the economic outlook is on the front pages of the news, not only in the U.S., but across the globe. We have a new U.S. administration, a global pandemic, lots of issues to talk about. In fact, we received over 250 questions from our alumni in advance of the call today, and hope to be able to address at least some of the most common ones today. Before we begin, let me make a couple of announcements. First of all, if you have not yet made your annual contribution to support the academic mission of the Tepper School, we invite you to do so. It advances our educational initiatives, graduates future business leaders, and enhances innovation for our faculty research. So we want to thank you for your support of the school. In fact, classes have begun for our master's programs, our MBA programs this week. Our undergrads will be starting a little later as they come into campus, but school has already begun for the spring semester. So now let me move on and be able to introduce our speakers today. Our faculty host and moderator is Professor Brent Glover. Dr. Glover is Associate Professor of Finance at the Tepper School of Business. He received his BA in Economics and Mathematics from Claremont McKenna College and his Master's and PhD in Finance from the Wharton School at the University of Pennsylvania. He joined the Tepper School of Business faculty in 2011 and has taught courses in finance and corporate finance to undergrads, MBAs, and PhD students. He held the Richard C. Green Jr. Faculty Chair in Financial Economics, and his research focuses on capital structure, credit risk, corporate finance, structural estimation, and asset pricing. We're so glad to have him with us as one of our young faculty stars in finance. Now let me briefly introduce our panelists. They each have impressive backgrounds, so I can only give just the highlights for it. Leenda Simpson-Delp from the class of 97 is currently Managing Director and Head of Financial Institutions Group for the Americas with BlackRock. She's based in New York. Prior to becoming head of the team, she served as deputy head and as a senior relationship manager. She joined BlackRock in 2009. Before that, she was vice president and client portfolio manager at Goldman Sachs, providing comprehensive multi-asset class portfolio solutions to the US and European insurers, pensions, endowments, and foundations. Before she began her finance career, she spent 2 years in Deloitte Consulting and doing management consulting in financial services. She earned her MBA with concentrations in finance, marketing, and strategy from the GSIA, now the Tepper School, and comes to us with a BS in chemistry and biochemistry with honors from the University of West Indies. She's also a member of the Tepper School Alumni Board and chair of our membership committee. Don Heberly from PNC was going to join us, but had a conflict arise, and so he's not able to be with us today. However, we're very glad to welcome another experienced alumnus, Jim Foster. Jim is Managing Director and Chief Investment Officer for Gray Court & Company. It's an independent advisory firm launched in Pittsburgh 30 years ago, which works primarily with ultra high net worth families and family offices on strategic and tactical asset allocation and investment strategy. Gray Court advises approximately 60 client relationships globally with $13 billion in assets across public and private markets. Jim is also a member of their management committee and leads their investment committee in determining the firm's capital market views and overall investment philosophy. Prior to joining Gray Court in 2005, he was executive vice president with Schroeder Investment Management, and before that, senior vice president with Mellon Financial Corporation for over 10 years. He got his MSIA, his MBA from the Tepper School in 1986, and his BA in economics from the University of Michigan. He's also taught as an adjunct assistant professor of finance at the Stern School of Business at NYU, and here at the Tepper School, giving over 70 business school lectures. So glad to have you with us, Jim. Thanks for jumping in. And our third panelist is Charlie Reinhardt. He's an undergrad from the economics program at Carnegie Mellon and is Chief North American Investment Strategist for Citi Private Bank. He's responsible for identifying investment opportunities and risks in North America across asset classes, as well as representing the Global Investment Committee's view across the region. Before joining the private bank in 2017, he was the chief portfolio strategist for New York Life's Mainstay Investments, where he led the firm's investment thought leadership efforts. Previously to that, Charlie was deputy chief investment officer for Morgan Stanley's wealth management, focusing on investment opportunities and strategies for them. Prior to that, he was heading portfolio strategy and as an associate director of research for Neuberger Berman, and before that, Lehman Brothers. So a very strong career there. He's also, you might have seen him on CNBC or other news broadcasts talking about Investment Outlook. He earned his MBA after Carnegie Mellon at NYU Stern School of Business. So 3 outstanding panelists for us today. Now I'm going to hand things over to Professor Glover and let him begin with a few slides and then introduce our panelists. Thank you.
Great. Thank you, John. Welcome all. Thanks for joining us. Looking forward to a great panel with our distinguished alumni. So I'm here to learn just like you. I'll make a reminder at the end here, but do feel free to put questions in the Q&A box. We, as John mentioned, got many questions in advance that I'll try to touch on, but things you would like answered that haven't been addressed, feel free to post those in the box. So to start our discussion, I wanted to just kind of frame a few long-run trends that I think are interesting and maybe provide some context to our discussion today. And some of these predate the COVID pandemic, and some of them perhaps were accelerated or amplified by the pandemic, but are likely to kind of remain even as we come out. So the first is kind of this decline in long-run interest rates and an increase in valuation. So this is taken from Bob Shiller's website. And this is the so-called CAPE ratio. And so he's taking a 10-year smooth PE ratio for the S&P 500. And the current kind of end of or early January value was around 33. And you see here this at the end going back as early as the late 1800s. And so this is relatively high given kind of historic measures. Again, this is, there's issues of how you measure this over time. There's composition effects. Maybe we've got more kind of growth, high market to book type companies in our index. And so that's pushing some of this up. Certainly the low interest rates are a contributing factor. But, one key takeaway here that many of you likely know is we saw this dramatic decline in stock prices following the onset of the pandemic. We've seen sort of dramatic increase and rise in valuations. Okay, so next slide, please. So the second, which is on that graph as well, is we see a decline in long-term interest rates. And this is just a pervasive phenomenon that has been going on. Again, I'm plotting here US 30-year treasuries going back to pre-1980. And obviously the early 80s had quite high rates, but even starting in 2000 or starting in 2010, we see this fairly steady decline. Okay, so these are nominal rates. And next slide, please. And similarly, you can look at a 20-year US Treasury inflation protected security or 20-year TIPS. And again, here, this is a little bit shorter time horizon, but starting in 2005, we see a drop, right? So it's around 2%. And starting in 2020, we're sort of in this negative real yield territory. Okay, so this obviously poses some issues for obviously institutions that have fixed liabilities and others that are trying to meet some kind of investment return target that we'll touch on in our discussion. Next slide, please. So second kind of interesting phenomenon, one that I've thought a little bit about in my own research that I'd like to hear folks' thought on, is this decline in the number of companies that are listing in the United States. So I'm plotting the number of, in thousands, the number of US publicly listed companies, and it peaks a little under 8,000 in 1996, and has had a steady decline. And so there are now fewer public companies listed in the US than there were in 1980. Now, there's dramatic increases in market cap. The sort of total size of the U.S. public equity in terms of market valuation has not shrunk, but the number of companies has. And so there's a lot of discussion, some among regulators, some among investors of what does this mean? So we'll talk about how this factors into asset allocation decisions. And next slide, please. And this shows up in pensions and endowments as well. And so there's different ways to see this. I was trying to find a nice plot. This is from Willis Tower's pension study in 2020. And I want you to focus here on this green sliver. Hopefully it's not discolored on your screen, but that's these other alternatives. And so in 1999, this was 6% of these pension allocations. And by 2019, they're about 23%. So this big growth and this covers all sorts of things: private equity, venture capital, but also, could be real assets, right? Owning sort of tracts of timber and so on and so forth. Okay, so this shows up in all different areas. But there's a lot of things about the sort of assets leaving the public market and pensions and endowments investing more in sort of less liquid private securities. Next slide, please. And then the final trend I want to talk about, which I think really sort of strikingly COVID has maybe counterintuitively amplified, is this growth into what kind of broadly I'm going to call sustainable or ESG environment, social and governance investments. And again, this falls under kind of various terms that people use, but this is from Morningstar showing fund flows quarterly into what Morningstar labels as sustainable or ESG friendly funds. And you see sort of steady positive flows of the green lines, but see a real explosion in 2019 and particularly 2020. I think BlackRock is in the news today. Larry Fink's annual letter dropped, so maybe Leanda wants to tell us more about that. But generally, this has become a big growth area, a big source of focus, and so I'll be curious to hear the panelists' views on how this shapes investment decisions moving forward. Okay, so with that, as these kind of long run trends as our backdrop, I want to now open it up to our panelists, and obviously some of our discussion is going to be about coming out of this pandemic, but also how some of these longer term trends interact with our hopeful eventual recovery and growth out of the pandemic. So Charlie, I wanted to start with you. And maybe you could just start by kind of giving us your broad outlook for global financial markets over the next year or so, the kind of immediate horizon. Do you see scope for robust economic growth? And maybe a bit about whether you see heterogeneity across, say, industries or geographic segments in this recovery, maybe based on who's getting the vaccine, but also just what industry you're in.
Sure, happy to do so. And thank you for having me on the panel today. So we think that for the year ahead, the U.S. economy is likely to grow at about 4%, and then the year after, 3%. It'll be a little sluggish in the first half of the year, but as people become inoculated with vaccines, we'll be embarking on a more normal way of life in the second half of the year with a lot of pent-up demand on services and things that we normally do when we gather together: travel, hotels, hospitality, etc. That being said, we expect the world economy to grow a little faster than the U.S. economy this year and next, maybe 0.5% faster than the U.S. economy. And in this kind of a backdrop, it should be good for profits. So we're envisioning for the U.S. stock market and also for global equities that profits expand by 20% this year or more, 10% next year or more. And historically, when profits grow, it takes equity markets along with it. We're not envisioning that kind of a return because we had a large rally last year because of the valuation starting point that we are at. We think for the equity market, we're likely to see in developed markets a mid-single-digit percentage return. What's probably more interesting is what happens under the hood, where we see a rotation. We see a rotation from some of the defensive parts of the market and also technology that did very well during the pandemic. We see a catch-up potential for those parts of the market that didn't necessarily do well last year. I think this is already underway. It began in small cap stocks. It began then after that in some of the more cyclical areas of the market. So we've been leaning into financials and industrials and some of the hard-hit areas that took place during the peak pain moments of COVID. I would say, in this kind of a backdrop, we also expect the Federal Reserve, who we will hear from tomorrow, to maintain a very accommodative monetary policy, but not just the Fed, other central banks around the world as well. And so we're likely to see short-term interest rates stay very close to 0% this year, next year, and possibly beyond. That's because inflation, we don't think is a clear and present danger at this point in time, but we do take the Fed at their word that they're going to try to lift the level of inflation over time. Back in August, they changed their policy. They're no longer trying to touch 2% in inflation. They now want to average it over a cycle, which means that if you've had below 2% inflation for some time, like we have, you might need to exceed it for a while in order to average it. And currently, the Fed is forecasting that we will not get to that point through 2023, that it might take a little bit beyond that for it to happen. But that said, with the economy growing, we do see, for example, a 10-year Treasury rate, which is at just over 1%, as we speak, could drift to 1.5%, maybe even 2% by the end of the year. Probably no higher than that. And so this is all factoring into the way that we're thinking about investments.
Great, thank you. And Jim, turning to you, overall, you have optimism about the global economy coming out of this sort of pandemic recession. What kind of things or factors would you point to as maybe signs of optimism? And maybe on the flip side, do you have sources of concerns or things you'd point to that we should pay attention to and worry about?
Sure. Well, I think that when you look at what markets are optimistic about, first, it's the fact that when you had in February and then through to March, the whole crisis with lockdowns and COVID, the Fed came in with massive liquidity to shore up market making, shore up the markets. So if you're an investor, you absolutely know that they have your back. That's first. And the fact that you've got continuing monetary stimulus provided by the central banks, you also now have coordinated fiscal policy happening with the federal government. So if you're looking at the first source of optimism, it's really continuing monetary and fiscal stimulus that's doing what? It's supporting incomes, it's keeping borrowers current, and it's actually generating economic growth. So that's the first source of real optimism. The second source of optimism is expectations of widespread and successful vaccine deployments in the US and around the world. Now, we've obviously seen resurgence of the virus. We've seen some mutations. We've seen problems in delivery. But when you look at how markets are pricing it, they're looking right through it. So yes, it may momentarily slow growth, but when you look back to the policy levers that are behind you, it's pretty easy to look through and keep investing. So I think generally expectations about vaccination and so forth are very positive. The third thing is that what people are seeing is actually revenue and earnings are improving. Profit margins are improving. Charlie referenced that. And what you're seeing is that real USD GDP growth is actually returning to pre-recession levels. So if you go back to the point of COVID when it kicked off, no one would have thought that any kind of V recovery was possible. They would not have thought that the actions that have been taken would have prompted the kind of growth and resurgence that we've seen, the recovery that we've seen. So I think if you're an investor, you're looking at those things and saying, I'm probably back to where I can ignore much of the lockdown environment. Now, what are the things that would or should cause someone to be concerned? The first would be that if you get some form of mutation that renders current vaccines or really prompt adjustments in the vaccines ineffective. So if you return to a longer term situation of lockdown, where in effect you essentially take GDP to zero and hold it there, that is not a great environment for profits. And that would certainly slow down optimism significantly. Pandemic mismanagement is another instance, right? It's being priced as if it won't be a long-term effect. But there's plenty of room for people running distributions of vaccines and so forth to mess it up. So pandemic mismanagement is another factor that would cause people to be concerned. And the third, really, and Charlie addressed it, there is a concern about growth pushing rates, rates in effect reflecting expectations of inflation and bond vigilantes coming back to test the resolve of central banks here and abroad. Again, those three kinds of factors would dampen optimism. But if you look at what the market is pricing today and what you're seeing across assets, it's a very positive and constructive view of future performance.
Great. That seems reassuring. So you both sound positive and optimistic to me. So Leanda, turning to you, how does this environment shape your asset allocations decision going forward? Coming out of this pandemic, does the strategy change in light of what's happened? And in particular, if we think about, again, this idea that maybe different industries or different geographic areas are going to experience the recovery at sort of different paces, maybe some of them just not ever bouncing back because the sort of reallocations are permanent. How does that factor into your thinking about asset allocation more broadly? Does the strategy change?
Thank you, and good to be with all of you. Good afternoon, everyone. So I'm going to, I think, offer some complimentary views. I definitely agreed with largely with Charlie and Jim, and really appreciate the opportunity to be on this panel with both of them. I take a little bit more of a client and distribution perspective, but certainly work very closely with my CIOs as important partners. My focus does tend to lean heavily towards institutional, but certainly can I think some of this applies broadly to other investors as well. And so your question was about how the strategy changed. I would say that especially given that institutional investors and hopefully most of us are long-term investors, then you wouldn't expect a radical change. But there are some important things, some of which have been touched on already, that do influence some of the moves, especially some of the tactical decisions that we would encourage investors to be thinking about now. Just going to frame them a little bit of some tactical and some strategic. So for these institutional investors, especially, and I guess everyone, you touched on in your opening remarks with that first chart about where rates are, and both Charlie and Jim touched on the new nominal, and we've touched on inflation. I think that is, of course, an important consideration for investors like the pensions, the endowments that you mentioned, and certainly insurers who I spend a lot of time with, who must keep significant allocations to bonds, right? But government bonds is not likely where you want to be putting a lot of your assets. So we're seeing, and I'm working with investors who are looking more towards an appropriate amount of tips, given the expectation for inflation where it is today relative to where it's been. So that is one tactical move. More significant moves though involve moving to more sustainable assets, which is another area you touched on, and I'm sure we'll go into it further. You mentioned Larry's letter, which did indeed come out today. And a substantial part of that annual letter by my CEO today's is about sustainable investing and ESG, which has in fact just really had a significant increase in focus and emphasis in the past year. When the crisis became evident in Q1 of 2020, there were some who believed that this would completely derail the interest in ESG and sustainable investing. In fact, what we saw in 2020 was that there was almost $300 billion by one of the measures, our measures, of investment in sustainable and ESG related solutions or investment strategies during the year. So in fact, there was a really significant focus. And so in terms of your question about change, I would say that is a notable, change because while there had been a lot of talk, just to see the amount of significant assets either looking for sustainable aware or avoiding things that could be impacted by climate risk or other ESG risks, that's pretty significant. I also just want to quickly touch on your point about alternatives. I know what you also mentioned that in your opening remarks, and I think it's important to answer this question because indeed all of what you said about the growth of private markets is very significant. And private markets is not for everyone, right? You really need to understand what you're getting into. But let's say for those who have the wherewithal, or you're an institutional investor and have the ability to evaluate the risks, we definitely see private markets as providing opportunities to fill in some of that yield that may be missing from the low rates environment. And so whether it be private asset classes, and there are a range of them: private equity, private credit, real estate, infrastructure, or they're even investment grade private assets as well, that those who are looking for more the investment grade platform. So those are some of the main areas of focus, I'd say, especially for investors who might be yield starved, who might feel that they're topped up in equity, don't want to really add more. I mean, with the valuations as they are, those are some of the big changes, and we can get into them further. I'll pause here.
Okay, thank you.
Brent, if I could just add to that, we deal with asset allocation mostly with very high net worth investors, and I can echo some of the themes that Leanda was just describing. We have, because interest rates are as low as they are, we've been finding that we need to make adjustments as well. And so, for example, we are currently siding with a higher allocation to equities than we normally have in the past, and also real estate investment trusts for clients that may not be using as many alternatives. But we also, the way that we're populating some of these different asset class buckets is also a little bit different. So we've, for example, been utilizing companies that pay and grow a dividend, not just pay, but actually grow a dividend. Oh. They know their cost of capital. They're making wise choices. Historically, a lot of companies like this also tend to have a quality bias and a higher than average ESG score for those that are scoring those particular types of investments. We've also found that for North American investors, dividend growing stocks blend very well with municipal bonds, which on an after-tax, after-inflation basis, those that are trying to generate income in North America, the conversation often does indeed turn there. But then also, given that the U.S. market has done better than a lot of the non-U.S. markets, we've also been tilting outside the U.S. So in our strategic asset allocation, we have a little over half of the equity exposure might be in the U.S., but the other half outside the U.S. And likewise, in our fixed income exposure, a little over half might be in the U.S., but we've been shying away from negative yielding European bonds, 0% yielding Japanese government bonds. We've been deciding more with opportunities in credit and looking for ways that we could reduce portfolio volatility, also generate some income, but we have to do it a bit more creatively than we have in the past because of the interest rate dilemma that you presented in your chart earlier.
Jim, how do you think about this issue for an investor looking at U.S. equities, saying, "Gee, these look higher than pre-pandemic," and admitting, both you and Charlie seem optimistic, but there are certainly headwinds here where many of us are still not back to normal. There are issues with the vaccine rollout. It's not all blue skies, and yet valuations seem higher than ever. How do you think about that, and do these valuations seem justified to you?
Sure. Well, I think, the question of are stocks overvalued, particularly U.S. stocks. Markets are clearly pricing successful economic and health policies. That's a given. Two, they're also pricing in persistent low interest rates and modest inflation. So if you look at the world on that basis, most valuation metrics are high. And at the same time, yields on bonds, rates, and spreads on credit are exceptionally low. Other risk premiums across the market are exceptionally low. So some people would refer to what we've experienced over the last few months as a melt up. And they would believe that just by nature of kind of behavior, a severe correction and a meltdown in the second half of the year wouldn't be a big surprise. When you start to look at the characteristics of the U.S. market, though, since 2017, the 5 largest stocks in the S&P 500 have driven performance. They've caused large cap to outperform small, growth to outperform value, and really caused domestic stocks to dominate their international peers. That's since 2017. But when you get to August of last year and you come forward to today, the S&P 495 have outperformed the remaining S&P 5, right? So also, if you start to look at it, equal weighted indices have started to outperform cap weighted indices. And the S&P 500, if you ratio it to the S&P 100, it's actually doing better than those very largest mega cap names. So the run that we've seen in the market since the low back in March, which I think was the 23rd, it's actually turned to favor small cap. And when you look at the way that performance has started to evolve with respect to capitalization, these other measures, what you're seeing is increasing breadth in the market. And that's actually positive. Fundamentals, when you look at revenue, earnings, margins on a forward basis, they're also fairly impressive. And recently, you've seen very strong PMIs, which tend to indicate positive expectations about future economic growth. So from that vantage, absolutely, you would look at the numbers, like you looked at the CAPE ratio at the beginning and say, wow, 33 CAPE is high. If you look at a forward S&P at 23, 24, what are you really saying? You're saying that in order to buy the companies that comprise the S&P 500, I'm willing to give up 24 years worth of their profits to have the joy of owning them. For me, that's pretty close to saying I'll be dead before they have any profits. That's pricey, right? So, but then you look at, well, again, what are my alternatives? Wow, I can have negative real yielding debt. What a thrill that is, right? I mean, I should basically just take the money out of my pocket and set it on fire. So as you start to look at what the alternatives are, many of them aren't very entertaining, let's say that. The issue in U.S. valuations, though, is that they're higher than what you see in the rest of the world. And we'll probably come back to this in a little bit when we talk about what the Fed is doing, when we talk about real rates and kind of capital flows and so forth. But at this juncture, when you look across the world and just broad indices, you would rather have exposure to non-US currencies. You'd rather have exposure to non-US markets. That doesn't mean all of them are great. There's significant differences in the way countries had policy flexibility when COVID hit. There's significant differences in balance of payments, a variety of things that would cause you to look at them and say, I like some, I don't like others. But as a generalization, you're better in terms of seeking returns as well as diversification to start to balance out of the states.
So on that note, we got a few questions about real estate and housing, and I'll pose this for the three of you as an alternative here. On the one hand, maybe this poses an attractive alternative. On the other hand, you might have concerns about COVID being a reshuffling in terms of who's living where, in terms of the extent to which people are going to go back to going into the office every day and the demand for, say, commercial real estate in a city center and so on. So what do you all have views on this? Do you see kind of a realignment in the real estate markets post-COVID, or do you think we kind of go back to something resembling where we were pre-pandemic?
Well, go ahead, Leanne.
Yeah, well, you go, Charlie, because I was going to quickly pivot back. But go ahead and answer the question, and I'll comment after.
Sure. Well, residential housing has done strong, has done quite well. We've had home prices have gone up, and then when we take a look at apartments, we've seen some migration from more expensive cities. There was a study published recently by Redfin where they showed that the most common migration patterns during the pandemic were from New York to Atlanta, Tampa, Miami, and I believe Nashville, Tennessee, from LA to Phoenix, Las Vegas, and Dallas, from San Francisco to I forgot what city, and then from Chicago to Cape Coral. As people have been seeking out more space and less expensive real estate. But there are pockets that have done very well during the pandemic, and this is sort of accelerated movements through the e-commerce acceleration that has taken place. Part of the real estate that we've been investing in, and our clients have been investing in, has also included warehouse space. And last I checked, people still prefer to live indoors, and so housing has also done well. With respect to offices, I think it all depends on your time horizon. As we return from work, the surveys that I've seen, suggest that it may be a little bit different than what it was in the past. That people recognize that the new optimal approach might be a little bit more time out of the office than beforehand, but enough to maintain a culture, and that teams might exchange positions. That the amount of square foot allocated to each person might change as a result of the experience that we've gone through. But that also offices need to be revamped to be more of an experience than beforehand. So a coffee bar inside the lobby, or different attractions to bring people together. So it'll probably change. We'll probably have but only 1/3 of all Americans actually have a dedicated home office that they're working out of, and that creates difficulty for having everybody work at home permanently. Also, Microsoft has done some studies that show when we do conferencing like we are today on Zoom, after 30 or 40 minutes, there's a fatigue that often takes place, or 2 hours of non-contiguous Zoom time can lead to fatigue. So I think
we're at 36 minutes, so we
less for us, because given the audience that we have, they could handle more. But the ability to focus is great. But on average, we see we're going to have to work around these things. But I would imagine it'll have some semblance of what we were accustomed to beforehand. But also the fact that that we prove a concept that we could work this way, that there could be a benefit to doing that and creating better work-life balance and for retaining employees. At some point the unemployment rate is going to be back closer to where it was pre-pandemic. And this is a great way to retain employees and work-life balance if you could be flexible in this way. Leanda, I know you can build on that.
Yeah, I'll keep it short though, because you covered a lot of the really key points. But I do think it's going to be, there could be some intricate ties with the sectors that really benefit, as we come out of the pandemic. I mean, when we think about and the trajectory is not entirely predictable, because if we think about sectors like tech sector, right, which is likely has been benefiting, is likely to continue to benefit. We would all say, look, Silicon Valley is going to just continue to expand. But in fact, there's been a lot of relocation from Silicon Valley, and we've seen a number of companies now willing to consider having like major hubs in other parts of the country. So I think it's going to be an interesting dynamic. There are some places that will eventually come back, for certain, but it's really it's going to be location specific. I think the key sectors that you mentioned before agree with all of those. Certainly, now is not the time to be doubling down on hotels unless probably you're a deep value investor. But it all depends on the type of investor you are. There are certain brand name franchises, of course, that they're going to come back because the demand is already there. People are ready to spend now for the benefit of getting vacationing when eventually we do. So lots of interesting things going on in that space. And let me pause since we're running tight on time and give Jim a chance to comment.
Sure. Well, I'll step back and just say the way that I look at investing, there's really three things, right? First, nothing good lasts for forever and nothing bad lasts for forever. And that's a non-technical statement of reversion. Two, I actually say to clients and myself, I want to engage in what will feel like unnatural acts of investing. In other words, you buy the things that you hate and you sell the things that you love. And the third point is that price actually matters, right? And when I teach at CMU, one of the things I say is, Brent, we're going to have a contest. You're going to buy 100 shares of IBM. I'm going to buy 100 shares of IBM. At the end of 1 year, whoever has the highest total return wins some fabulous prize. We stipulate the company doesn't go out of business. And then I say, you pay $1 billion for your 100 shares, and I pay $100 for mine. And, I ask the students, who's going to win the bet? Right now,
that's right.
Neither one of us buy or purchase are going to affect the cash flows of IBM. So obviously, the lower the price you pay, the better. And my original history was as a market maker. And so my attitude towards investing is often profit from catastrophe. It's harsh, but you really want to take advantage of prices being destroyed. You really want to take advantage of places where capital is left. And as you pick apart aspects of real estate, and you get into many of the niche areas, as Leanda was saying, there's debt that is able to be purchased at very low prices. Not saying that you go in and foreclose, but you've created the opportunity to acquire properties or operations at very effective prices. You've certainly got a good return if they don't. If they do, great, you're in business. So we look for places where those opportunities exist, where there's skilled operators to take over and manage, create value if there's things to be repaired, and so forth. So as you look across the kind of real estate world, there's many things that are very pricey, yet there are places where you can eke out very interesting investments and make money because you're buying them at very attractive prices. And you presumably you were doing this a few months ago, but when everyone's most afraid are the times where you actually want to step in and deal.
Yeah.
Right. Especially as a long-term investor, absolutely. Makes a lot of sense. Brett, before you ask the next question, I thought we should just quickly go back to a point Jim had made about, going outside of the U.S. I think it was in the prior question, because I think it's so important, especially now. And, when we think about diversification, I think sometimes not enough people, especially U.S. investors, think about geographical diversification. And it's definitely one of the areas that we, at our firm is really focused on as one of the main themes. And it makes a lot of sense. As I said, Jim teed it up. And I wanted us to just extrapolate on or just expand on it a little bit more, because if you think about the remaking of global supply chains in 20, based on what happened in 2020, there are a lot more considerations there. That's not just about production costs and efficiency. You have to also think about the relationships, like relationship with China, and which is complex, may not be enough of an adjective for it. And now we're facing with a new administration who's probably going to continue some of the policies, but integrate it into a broader approach, hopefully holistic approach in thinking about so many other things with respect to China, which just actually had, we all probably saw the big headline of the, significance of their foreign direct investments, moving, significant foreign direct investments, which just came out, I think it was yesterday. So I think it's useful to just highlight, we think global diversification is important. Definitely think China is an important place to look at. EM equities broadly, are very worthy of a close look, especially if you can handle the volatility and you take a long-term view. And coming out of the pandemic, a number of the EM equities should be well positioned to actually eventually, see a nice rebound. If your vaccine and all of these other things, and hopefully mobility returns, and service sector is able to eventually rebound. So just wanted to throw that in there before we wrap.
I would agree. One of our unstoppable trends is a G2 world, East and West, US and China. And with the new administration, we expect a different approach in policymaking, but some of the same flashpoints around technology. Hyperconnectivity is another one of our long-term themes. But we believe that it's important to invest in both ecosystems, the East and the West, including the technology ecosystems. And to Jim's point earlier, stocks are less expensive outside the US. So for example, if one takes a look for the entire stock market outside the US, it's trading at a forward price earnings ratio of 17 as opposed to 23. In emerging markets, it's 16. There are depressed currencies, we believe, in Latin America right now, which is trading at just 13 or 14 times. And so our largest overweight tilt, our largest tactical tilt right now is to emerging market equities, which also happen to have more cyclical industry representation in the kinds of sectors that we would anticipate will recover once we get ahead of the pandemic. And the world becomes more inoculated. That's really key. That's our get out of jail free card for those familiar with the game Monopoly, is inoculating 70% of the population.
I would come back in though and say I think it isn't just geographic diversification. It's actually what currencies do you pick to hold assets in, and I think separating your equity view from your rates view, your credit view, your currency view, what you think about real assets is very important in this particular environment. And we didn't spend any time on it really, but one of the bigger fears, of course, are people who are worried about national debt denial, right? And I think when you look at it that way, what is the problem that's going on in the background? It's the whole kind of basing policy through this lens of modern monetary theory, right? And when you think about the world that way, what does that theory actually require over time? Because we're clearly pursuing some variant of it. Well, it requires persistent low interest rates. It actually needs growth rates that exceed those interest rates so that at some point when you do slow down your growing leverage, you need a positive spread in order to be able to pay it back down over some length of time. And it actually contemplates a future time where you stop borrowing. So, we'll see if that actually happens. So last, it needs a supply of ongoing investors that actually are willing to buy sovereign debt at attractive rates to the government. So I think when you focus on that kind of world and you think about diversification, what's going on? You've got these massive long-term debt obligations, near zero nominal and negative real interest rates in the advanced economies that have actually forced the need for coordinated policy. Right? Monetary policy is inadequate in that environment. You just can't get anything stimulated and going. So you coordinate and you bring in fiscal policy, right? And that's what everyone's been doing since COVID. It accelerated that whole way of trying to deal with massive debt overhangs through time. But when you look at that kind of combined stimulus, where has it had huge impact? It's had huge impact on currencies and on currency volatility. So increasing inflation expectations in the States, what they're doing is creating larger negative real yields because, you're having expectations of inflation going up, but the Fed is suppressing rates. They are, in fact, targeting the curve. You saw that, just in the last few weeks. So the only way you see that inflation expectations are going up is that real yields are falling. Well, what does that do? That puts tremendous pressure on other currencies. It does set that testing for central bank resolve. And it ultimately leads people to think about capital controls, right? But when you look at the rest of the world, when you look at Asia and other emerging market economies, they have much greater capacity, policy flexibility to accelerate growth in future slowdowns. And that confers a really distinct advantage on them. And that should lead investors to seek out investments there for both return reasons as well as diversification reasons. And I think that's a big aspect of what domestic investors have to come to grips with, because there's been such a hatred of emerging markets and non-dollar currencies for a while that all of a sudden, when you most dislike them is the time when you probably should start building them into your portfolios.
Interesting. So I want to, we're running low on time, not surprisingly, because we've got lots of great insights, but I wanted to turn before we end to ESG, and we've touched on it a couple of times, but Leanda, I'll start with you. As an outside observer, it seems that ESG maybe means different things to different people, but broadly speaking has kind of gone through a bit of a growth and evolution, not just in the uptake, but in terms of the scope of what it's trying to do. Maybe 1.0 was kind of an index minus some vice stocks of things in firearms or tobacco or coal or oil and so on. And sort of, I don't know where we are, version 2 or 3 or where we're at now, but maybe if you could just give us a little bit of insight into where you see this evolution going. It seems that the uptake is increasing, but also the scope of kind of what it's trying to accomplish going forward.
Sure. And I'll make it brief. It definitely means a lot of different things to different people. And I think that has been maybe part of the fundamental challenge in figuring out how to invest and really how to move forward with ESG considerations in a concrete way. But recognition of that fact, and there's been some research, there's some data out there that for us at BlackRock, we use that as a motivation to focus around measurement and transparency and sort of getting the understanding into a common place, numbers are a common language that people can coalesce around and understand the facts. And so that's been an important place to kind of help to bridge some of the differences that you talk about. And so there have been, there are a number of data providers out there. One of the things we are doing, which I can, speak to, is we created this thing called the Aladdin Climate Tool. We do use partners to provide some of the data, but it's all about helping to quantify some of those risks that we talk about that are embedded in, that are part of ESG consideration. And certainly one of the most significant of those risks is climate risk, which we do believe is a real financial risk. And that when you can quantify it, incorporate it in your considerations for financial investing, and you will get, many or most investors sort of using the same language or similar, then you can really sort of make some progress towards that. So we see a global momentum towards pursuing net zero and greater understanding of sustainable investing and greater alignment with like the Paris Accord or the 2-degree aspiration, which is really hoping to get below that level of climate of temperature rising that will hopefully avoid harmful effects of climate change. And so understanding and being able to be deliberate about risk taking. So integrating that understanding of your climate risk into like your investment portfolios. For us, we're looking to integrate it into our capital market assumptions. So those are the fundamental assumptions that go into our projections by asset class. And then providing a lot of transparency around that to our clients, to our investors, and to others. And then using that information to not only quantify risks, but to define opportunities. Because the last thing I'll say on that is that we're actually seeing that companies that are more aware of their, ESG impact and are, able to show their differentiation, whether by avoiding something negative or taking a more positive ESG awareness, we've seen through various studies that they're actually benefiting, whether their customers, various stakeholders they're benefiting from that. So we absolutely see benefit. And it's a topic that could take a long time, but again, I'll just stop there.
Okay. Charlie, if I could just sort of put it to you in terms of how you see taking this framework into private markets. So some of the transparency, it seems, is well suited maybe to a large public company, but how you think about applying this to private markets?
Sure. So we have an Investing with Purpose platform because this is an area of interest for many of our clients and for us. Our internal work shows that that companies that do score better with respect to their ESG practices and procedures tend to produce favorable returns with actually less volatility on average. We've also found that the inflows that you presented in your chart at the beginning of the call have not led to an outsized difference in valuations between higher ESG scoring stocks and lower scoring ESG stocks. But we're trying to factor them into our approach because we think that this is material information and it provides making a more complete decision making on a more complete information opportunity set. And so we think that it's very important, and that the world is going this way. I would mention another one of our unstoppable trends is greening the world, and some good news on the renewable energy front is that for producing electricity now, it's now less expensive to use renewable energy to produce electricity than either coal or natural gas in the U.S., in China, and in other parts of the world. And so because it's the low-cost solution, we think that that's going to accelerate the pace by which we see this change. So in the last decade, we've gone from 10 to 19% of our electricity production coming from renewable fuels. But now that it's a low-cost solution, we would expect that pace to pick up. That's very important because if you want to convert 3 trillion miles driven in the United States over the course of time, you're going to need more electricity. And the studies show in a state like California, you might need 50% more electricity, everything else being constant. In a state like Texas, you might need 30% more electricity, everything else being constant. And that kind of like loops back to the remarks that Leah made earlier on infrastructure. But we agree that the world has a different level of interest today. That we're recognizing that there's information that's very important, for our long-term investments, that we have to try to find ways of embedding and incorporating that information and turning it into intelligence to make better investment choices. I would also add that if you look at the municipal bond market, you could argue that 75 or 80% of the municipal bond market is also consistent, with ESG-friendly investing. And so we've also been looking at it in real estate too, like the kind of adaptation strategies that companies are making for properties that are close to coastal areas. Are they moving back their new construction? Are they moving their power generators from the basement to the roof? What other things are they doing in order to affect the capital?
Okay,
I'll stop there.
Great. So we're running low on time. John's messaging me to keep my eye on the clock. So just maybe to wrap up, for each of you, I know you've been active members of the alumni community. You're certainly distinguished, accomplished alumni. Maybe if you could talk a little bit about just how Carnegie Mellon or the Tepper School has impacted your career and what this alumni community has meant for you. And maybe just a word on advice for younger alumni, especially in these times. I think, maybe we'll have a slow return to work, but maybe working from home, being distant, if you're a new member of an organization, can be a challenge. So maybe sort of given our current unique circumstances, any advice you'd have for younger alumni? Jim, you want to start?
Sure. Well, I think I'm the only person who ever answered coming to GSIA that I came there for romance. I had no idea that it was a good school. It was purely a romantic decision. And when I let that be known, they posted it in the admissions office because no one apparently had come to Carnegie Mellon for that reason before. But what I particularly appreciated about Carnegie Mellon and the work that I had there, one, it was training in very thoughtful, disciplined problem solving and an empirical basis then to affect decision making. And it wasn't blind use of models. It was very much a Bayesian approach where it was, what do I know? What are my views? How do I deal with new evidence as it comes in? And how do I make my decisions sequentially as a result? And I think that overall training of being approaching problems, being skeptical about the data, really thinking through how to model things, interacting with models to make them smarter, letting them keep you from lying to yourself. That whole approach was actually very useful. I think the other thing that I picked up in my time, and we were still a class of maybe 100 people, 100 plus, but there was very much a sense of, for example, when we went to talk to firms, the first question was, what are they trying to achieve? What are the people that work there that are interviewing us trying to achieve? And how do we actually think that we can create value there? What would we contribute? Why would someone want to hire us? And researching them, understanding those kinds of things actually was very differentiating because we didn't walk in saying, we're a gift to the world. How much are you going to pay us? We came in saying, this is what we think you're trying to do. These are the places where we think we might be able to add value given the way we've been trained. And, let's discuss it. And I think that orientation toward work, toward employers, to be thoughtful, to be, humble in the way you approach it, to think about what the firm is trying to achieve, what the people who work there are trying to achieve, and really then endeavoring to make them fabulously successful. That's the way that we were trained to be successful ourselves.
Charlie?
I learned to think at Carnegie Mellon. I learned to think critically. I also was the first time that I interacted and collaborated with people from other countries, friends from India and Singapore and other places around the world. And if you're a curious person, Carnegie Mellon is a pretty wonderful place to be. So, and I think it continues that way. And it was helpful in my career in the sense that I got my first job out of college at Carnegie Mellon because somebody who had graduated 2 years before me was successful in doing. People thought very highly of his performance, that they just basically wanted to fish in the same stream. And so when my resume came through, I was hired after just a single interview. So it was great.
So you're paving the way for all our current students. They're thankful for the three of you. Yes. Leanda?
So I have to comment on Jim's going to Carnegie Mellon for romance. I was sort of like the opposite of that. And in fact, I went not at all expecting romance, but I ended up marrying someone from my class. So hopefully your romance worked out, Jim. You can tell me about it afterwards. He's nodding. Yeah, so that's great. Yeah, so I came here from Jamaica and planned to be here just for 2 years, and partly because of the romance, I'm still here. But it's obviously worked out well. Carnegie Mellon gave me an incredible education. I really sharpened my analytical skills. I mean, I think I had the right work ethic, but you really learned, through persevering and the rigor and just the payoff from really working hard. And then having the support of a smaller environment where faculty were accessible, where teammates were from all around the world, as Charlie said, incredibly bright. And you realize quickly that I might be bright. There are other people who are bright or are brighter, and you learn from each other. And it was just an incredible opportunity. And so it was great. Really, I really think it gave me a great start. And I continue to be passionate about the school and the community. I stay in touch with a number of alum, and obviously I'm on the board. So John gets to talk to me perhaps too often for his liking, but it's been great. I love being involved.
Great. Well, that's a great place to leave it. I want to thank the three of you for both your time and effort today, but also being active members of this alumni community, being great representatives, and we're just very thankful to have you participating in these events and just out there in the world, bringing positive attention to the Tepper School. So thank you for all that you do. And we wish everyone health and happiness, and hanging in there as we come strong out of this pandemic. Be well, everyone, and still take care.
Great. Thank you so much to all of you. Thank you, Brent.
Thank you.
Take care. We hope to see you at our next alumni webinar. We'll be announcing it soon. Thank you.
Great.